If you can, please mute yourself until the very end if you have a question. As well, if you do have questions that arise as we were going through the presentation today, please use the chat box that's on your screen. Here in a second, what we're going to do is reduce ourselves from being shown up here, and we're going to bring up a slideshow that Matt has prepared. First and foremost, Merry Christmas from everyone here at corporate to you and your family. Happy holidays. And we thought it prudent as we ended the year here that we would discuss a bit about gift giving and in that context, financial planning. As everyone knows, we have the deferred comp program many of you take advantage of, and we strongly encourage all of you to take advantage of as we and you together invest in your future. So that being said, I've got with me today our CFO, Matt Radencic. Matt runs this program. Matt is phenomenal when it comes to answering questions on this program. As well, we've got Drew that's going to pop in for a bit, a couple slides in to take on some information as well there. So without further ado, we're going to turn it over to the slideshow. Again, if you have any questions, type them into the chat box, and we'll be happy to answer them as we engage in this dialogue. So bear with me a second while I share the screen. And I guess, Matt, I'm going to start with you here. And my first question is, why did we set up a deferred comp program?
That's a great question. Thanks, Nathan. Real estate agents are some of the busiest people that I know. I don't have to tell you that, our audience here. You know, between listing appointments, open houses, and filling out checklists, they don't have a lot of time to think about their financial future. So way back when, Ron McColly realized, hey, if we could put savings on autopilot and keep the money tax deferred, that it'd be a way to build wealth. So in 2003, he rolled out the Performance Plus Deferred Comp Plan from McColly, a unique one-of-a-kind plan.
Okay, so share with us, how exactly does this program work?
All right, you can see on the slide, we elect annually $50 to $200 per transaction, and you can go up to a maximum of $10,000 this year, the same as last year. Company will match 50% of your deferrals up to $1,500. So a little secret here, $3,000 will get you the maximum bang for your buck with the company match. So I encourage you to at least defer $3,000. That'd be, 15 sides at $200 each.
Right.
We have 3 investment options, and we'll get into those in a little bit. You choose one per year, and there's a 5-year deferral period. And we can, I can explain that. It's kind of confusing for many people. So why don't we go to the next slide and explain that.
Before we do that, so to be clear, so if you are an existing agent and you want to sign up to participate in the program, is there a deadline to do so?
December 31st of the previous year. So we have until December 31st, 2020 to sign up for 2021. And that is not our rules, that's the IRS rules. So there are certain rules we need to abide by for this non-qualified deferred comp plan.
Plan rules. Okay, so if you're an existing agent, you're not signed up, make sure that you're signed up by the 31st of this year so that you can fully participate next year. And then if you're a new agent that joins us mid-year, you can then have 30 days to sign up for that year.
That's right.
Okay. Now, talk to me a bit about one of the things you mentioned before, it's still on this slide, is there's a 5-year deferral period. So if I invest $3,000 next year into the program, McColly matches $1,500, that grows for 5 years?
Yeah, the sum of the two, be $4,500 in your example, would grow, be deferred for 5 years, and would be payout in January of the 6th year.
Got it. Okay.
So continuing on with that, your example here, let's say you did defer $3,000 this year in 2020. Company matched $1,500. So a total of $4,500 goes, is invested. At the end of this year, the deferral year, we call it, we strike the price. We get the value of your index, which we'll discuss at the end of this year, determine how many shares in the agent account is invested in the 5 years. That would be 21 through 2025. So right there, think about it, you just saved about $1,125 in taxes immediately because you're not taxed on that money. You're deferring it. You're deferring it to a later date.
Right, right.
Okay.
So if we added that, for example, at $3,000 onto your 1099, that would get hit with whatever tax rate you're at for the year. And by removing it from your 1099, you're avoiding having to pay taxes on it for that particular year.
That's right. But not only the $3,000, the match also not taxed to you until
Okay.
it's distributed after 5 years.
Okay, all right.
Okay.
So you've mentioned here, Matt, that we can defer the money. McColly is going to match the money. We've discussed that you can save money in taxes because you're deferring and delaying the payment of taxes on it. Talk to me a bit about, we're going to turn the page here to how can we invest it? What happens with it during that time period? Is this a CD that, we give you 3% interest, or what happens there?
Well, it depends on which of the three investment options you chose, right? So let's say it's the option B, which is the simplest, the treasury note rate, minimum 3%. So the $4,500 in our example goes in and gets invested at 3%. It just so happens that using this investment option, you know exactly the value at the end of year 1, 2, 3, 4, and 5, and you know how much you're going to get in January of the 6th year. Mm-hmm. That's the only investment option where you have certainty. Okay. The other two options, and we'll get into that, do vary. They can go up, they can go down. You can have unrealized losses in some years, unrealized gains in others. We'll get into that a little bit.
Okay, so we're talking kind of about the life of the deferred comp program from start to finish, and then we'll dive deeper into the guts of how you can invest it in a bit. So I want to come back then to the tail end of the life at the end of the 5 years of your investment. So you've submitted your $3,000. You can go up to $10,000 that you defer in a year, correct?
Right.
And McColly has done their match. You've picked option A, B, or C as to how you want it invested. We've gotten to the end of our 5th year, okay? And as you indicate here on the screen, so if you had a deferral of $3,000, company match of $1,500, grew at 9% for 5 years, that $4,500 5 years later is now worth almost $7,000, correct?
That's right.
Okay, so what happens then?
Well, you get a check from us. Okay, now here's the important part. What do you do with that check? Now this is, it's very important that you understand, because this is really where the rubber meets the road, I think. That check is going to be taxable to you on your 1099 miscellaneous form in the year of distribution, okay? So what can you do to keep it tax deferred? Mm-hmm. And that's where we get into qualified retirement accounts and placing it into a qualified account. So I understand we have someone.
We've got someone knowledgeable on that.
Okay. So
I'm going to step aside. I'm going to invite Drew to come in. And Drew, if you want to share with those listening in this afternoon a bit about what folks can do once they get that check. You want to sit here? Let us know what they can do with that money.
Sure. Good morning, everybody, or afternoon at this point. Yeah, just wanted to, well, let me start off by saying I'm glad to be sitting next to an accountant during this conversation to say, and having a lawyer not too far from that either is ideal. But yeah, no, just when you're getting when you get your check, I know Ron has said, go ahead and give us a call, give myself or Reese McColly Fleener a call on that. What we really want to do is just kind of point you in the right direction. Obviously, I'm not a licensed broker or anything like that, or setting up, or able to set up any kind of fund or trade for, or brokerage fund for you to trade on. But we want to point you in the right direction and let you know that you do have options when you get that check. So essentially, there's the 3 plans, but what they really are is an index. You don't really own stock in anything with that. So once you get your check, if that's an option that you want to do, we can point you in the right direction for that. And, one of the main things that we always talk about and I know Ron very, very much believes in, is Berkshire Hathaway. And that's one of the things I get called most on, and questions about that company. And there's a good reason that, Ron has believed so much in it, and why he does. What Ron wants to impart is just share the benefits that he's had, by investing in a company like that, and share those with people that he cares about, which is everyone that, is here at the company. And, it's just, he wants to let everybody know that through years of research and trial, error, that this is a company that has yielded some great benefits for him. And, and that's why it's offered as one of the options for the deferred compensation program. Would you agree with that, Matt? Would you
Absolutely. And maybe we can go through each one of these to explain exactly what the agent would do with the money. Let's say they got the 6924 check.
Yep.
They're going to go to bank. Do we have a preferred provider bank?
There's a few. I know Wells Fargo can, who's also partnered with Berkshire, but I know that they have people that can help out with that. Any financial advisor can help you with that, a certified financial advisor. If there's any questions on that, let us know. I mean, we can give you a list of some people potentially that, maybe I could personally recommend, or, get a kind of a consensus of some people that other people do use that do come highly recommended, and you can make your own decision on that.
Yeah. So they set up a regular IRA account, a Roth IRA, or a SEP IRA. These are qualified accounts. Regular IRA, they can contribute up to $6,000 or $7,000 if you're over 50 years old. Same with the Roth. SEP IRAs, simplified employee pension plan. Those are for self-employed individuals only, but you can defer a tremendous amount of money, 25% of your net income.
Right.
As you know, up to about 56,000, I believe. Tremendous amount of money. So those are three options where you can keep those money tax deferred, and that's the important part.
Yeah, and so when you just roll it in, then again, it's the miracle of compounding, I believe that is the term, and just continue on with that until you're ready to start drawing from that account. But the main thing is obviously is to set something up in that arena, and that's where, if you do have any questions, we're happy to again point you in the right direction. Hopefully, if, do you want a broker? Do you want to set up a brokerage account? Do you want to talk? Have some more of a financial plan going on? Then you can kind of break that down, because the main thing is just trying to know where to start and then go from there.
Right. And we should say we receive no additional compensation through referrals from for financial planning.
Absolutely. This is why it's important to sit next to a accountant and talk about this for sure. Absolutely. So again, if you have any questions on any of that, pointing in the right direction, happy to help you out with that, and continue to do so. Okay. Thanks.
Thank you, sir. We appreciate it very much. I want to dive a bit deeper, Matt, into the options that we have as a company. So when this was set up back in 2002, we were able to take a look at and choose what sort of interest-bearing accounts we wanted to set up. So describe for our listeners here the three different investment options that they can choose from.
Yeah, this is probably the most frequent question I get regarding sign up. Which option do I choose? Well, it depends on two things: your risk tolerance and your time to retirement. Okay, so what's your risk tolerance? I like to think of it as put your money into stock market. Are you going to sleep well at night? Some people worry about it and they think, oh my gosh, the market fell today. What was the impact? Well, you have a low risk tolerance, right? Other people say, it's in the market, let it ride. I know it's going to go up, and I'll be fine. That's a high risk tolerance. Mm-hmm. So we have all three options are attractive for different risk tolerances. Time to retirement: if you're 62 and going to retire at 65, you don't want to put something in. You don't want to put your money into the market where we could suffer 1 or 2 years of a down market and not have time to recover. Mm-hmm. So that's probably generally not advised. So those two things.
Okay. So option A here that we have is to invest in Berkshire Hathaway. Is that stock B?
Yeah. Berkshire Hathaway, if you don't know, is a conglomerate run by Warren Buffett. And the expert is Ron McColly. He can talk about this company and everything about it. They own Dairy Queen, Duracell, Pampered Chef, Helzberg Diamonds, Kraft Heinz, amongst many others. This is the return of Berkshire stock since inception of our plan. You can see there have many up years and there's a few down years. It's the average is 9.5%, and that's the dotted line. So it's important to note we will have down years in this option.
So for example, if you started investing in 2014 for your $4,500, you would capture for that 5-year period the rate of return that happens in 2014, 2015, 2016, 2017, and 2018, correct?
If your deferral year was 2014, you would be invested in 15, 16, 17, 18, and 19.
Okay, so you'd capture the interest aggregate over those 5 years.
That's right.
Got it.
That's right.
Okay. What else do we have? We've got option B, which is the T-note. What does that mean?
T-note is a treasury note. It's a U.S. security. It's currently yielding under 1%, about 9.9. As you may well know, you don't get much in your passbook savings anymore. And this is one reason why. But we give a minimum 3%, which is a pretty good deal considering the yield is 0.9, right?
Right. So that's almost like a guaranteed CD that you would have.
That's right. That's
Okay.
right.
And then option 3, we've got, or C, is the S&P 500 index.
Yeah, the S&P 500 is the 500 largest U.S. publicly traded companies. And it's a basket of securities. It's an index. And as you can see, much like option A, we'll have up years and down years. 2008 was a particularly bad year, if you may recall. I'm sure everyone does.
Yep.
But that averaged 8% since inception of our plan.
Okay. Now, a question, Matt, is, so say I start investing and the first year I choose S&P, and I'm kicking myself because I didn't go Berkshire. Can the next year I choose for that 5-year period to be in the Berkshire? Or do I have to, once I start, I can only keep it in one fund?
You select your fund for each year.
Okay.
Okay, so you can go Berkshire 1 year, S&P 500 the next, and Treasury note the following.
Okay.
But once you select it, you can't change it for that 5-year period.
Got it. Got it. So we've talked through the options that you have for investing over the 5-year period. The last thing that I want to take us through is just some of the communications that the agents will get from your office. I know you got some great details on here. If you can just help us look through this document, help us understand what information is being remitted on here.
Yeah, this is your account statement. It's similar to a mutual fund if you invest in those. The first box upper left shows a value recap. Beginning value, the changes in your account, and equal the ending value at that current quarter end. Okay, and these are quarterly statements. Right underneath that are the indices. All 3 are shown there. Last year's value and the current year value. On the right, you see your deferred contributions by year. These are your deferrals in the blue, and the company match that corresponds with that year.
Okay.
Okay. Now on the bottom shows the value of those deferrals. Okay, your elective deferrals, what's it currently valued at, as well as the company match. What's your investment option? And finally, on the bottom right, your distribution month. When will we distribute that tranche, that year's deferrals?
And how often do the agents receive these updates?
This is a quarterly statement.
Okay. Yeah. So that shows the values that they've increased over that quarter.
Right. We don't have this currently online, so there's no portal you can go to and log in and get it. Hopefully that'll be something we offer in the future.
Okay. Now my financial advisor tells me he's floating me a square when he says I'm only going to charge you 0.7% of your positive growth. What are we charging for managing these accounts for the agents?
We charge nothing.
That's another benefit.
Yeah.
Okay.
That's right.
Okay. So on top of you got the tax benefit that's being offered. You're not paying the taxes for the year. You're deferring it to a later, lower tax rate. Okay.
Yeah.
Well, Matt, I appreciate the information that you've assembled here. This is great information. And I think what I'm going to do is turn off the slideshow now, and we will see if any of our listeners here have any questions. Frank, Ruth, any questions out there?
Joe, any questions out there? Oh, Matt, where can they find the forms if they want to enroll by the end of the year?
Okay, those are on McColly Connect and under company corporate downloads, file downloads. You can also look for email that we sent out under the corporate email that has those attachments. And we'll send out one more reminder before the end of the year.
Okay. Any questions from anyone?
I have a good one, Matt. What if I retire and get out of the industry? What happens with my money? Do I get the company match? Do I not get it?
If you retire, that's a great question.
I mean, I've got a lot more years, but I was just.
Are you thinking of retiring soon? This isn't your question, huh? Okay. If you retire, you get, you don't lose anything. You will continue to get the distributions as they're scheduled out on your statement.
Okay, that's a good question.
Oh, wait, let's see. Will you accept digital signature for the opt-in form, Edie?
Yes, Edie, yes.
I have.
Used to be, we wanted the wet signature, but that's not necessary anymore.
Sue, she's not gotten a statement before. When can she expect it? She's a new agent this year, and she's been with McColly for a year.
Okay, you would have gotten one for September if you had deferred any amounts.
Are they sent to the office or emailed?
No, they're mailed to the home address.
Mailed to the home?
Yes.
So Sue, you could shoot Matt an email just to make sure we have the correct things on file. Good question.
Yeah.
Shelley Faber, is it only $200 per transaction? Wait, is it only $200 per transaction, but I want to exhaust the ability to defer 10,000?
Yeah, the way the plan is set up, 200 maximum per transaction, up to 10,000. So the constraint is the $200. That's the max you can go.
And that's the way that the plan was originally designed and set up back in 2002, similar to like a 401k plan where it's 3% of, you know, what a paycheck is, so to speak. But that's just the restraints of the system, of the way that it was set up and limitations that we had from the IRS as we understand it. But good question, Shelley.
Anyone else want to use the chat box or unmute themselves? If not, we will wrap up a couple minutes early.
All right. Well, very good.
Let's, I want to.
We have one more thing.
Yep.
Yep.
We have this brochure that I wanted to make sure everyone has seen. It's really outstanding. Explains in more detail our wealth building program, Performance Plus, some unique concepts in here, as well as we have a FAQ document on McColly Connect just about Performance Plus. So if you have any questions, you can go right there and generally you'll find the answer there. Or you can call me or Nathan.
Absolutely.
There's really good stuff out there.
Reach out at any time. We want to see your hard work invest and grow. So again, thank you to all for participating here this afternoon. Have a great rest of the week. Have a great holiday and Christmas next week, and looking forward to seeing you all soon.
Merry Christmas.
Merry Christmas. Thank you.
Bye.